There is an elephant in the room, or at least it will be imminently in the room. So let me start with that. Sherrod Brown, chair of the Senate Banking Committee, told us last night, as far as he knows, it is down to Lael Brainerd or Jay Powell for the next Fed chair. You've worked with both. What would be the policy differences between the two? How would the Fed change, if at all?
I think no matter how this comes out, there'd be a lot of continuity in Fed policy. Both of these players have, long track records at the Fed. So certainly, it's a big committee. Also, I think people have to keep that in mind, and there's a lot of experience on the committee. So I think we'd see continuity.
Would you anticipate any change in the timeline for tightening policy? And I'm going to use that broadly to mean tapering and raising rates and forward guidance, anything that you might do between one or the other?
It's a committee decision, and it's as I just mentioned, it's a big committee, and lots of opinions around the table, great staffs around the Federal Reserve and at the Board of Governors. So it's a collective process, and we have to react to the data and make decisions. So the chair's job is really to guide that process, I would say, and get to a good compromise in the center of the committee.
Well, certainly you've got opinions, and you've expressed them on what the Fed should be doing, the possibility of a faster move to tighten policy. But you've also, as you just said, put that on the data. The data are showing very strong inflation, and it shows up in the retail sales report this morning. Are you ready to say we should move more quickly?
Yeah, I actually didn't see the report here. I was getting ready for the interview, but the inflation rate is quite high. The core PCE inflation rate, the committee's favorite measure, is about 3.6%. That's the highest it's been in 30 years, well above our 2% target. And that number already throws out food and energy. So, you're taming the data a little bit when you look at that kind of measure, but it's quite high. It does not have the reputation of moving down very easily. So I think it behooves the committee to tack in a more hawkish direction in the next couple of meetings so that we're managing the risk of inflation appropriately. If inflation just happens to go away, we're in great shape for that. We're set up for that. But if inflation doesn't go away as quickly as many are currently anticipating, then it's going to be up to the committee to keep inflation under control going forward.
Well, when you say tack in a more hawkish direction, are you talking about speeding up the taper, even with a risk of a taper tantrum? Are you talking about changing forward guidance? How would you tack?
I think we've gotten past the taper tantrum issue because we went ahead and went ahead with the taper here. But we could move faster. We kept optionality on this, that we could speed up the taper if it's appropriate. We have a hot CPI report here. As you know, I've advocated a faster pace, a 2010 pace. That's 20 per month less on Treasury purchases and 10 less on mortgage-backed security purchases. The reason I propose that is that we would be done tapering at the end of the first quarter next year, and that would give us a little bit earlier moment that we could assess where the data is and decide what to do on rate policy. Yeah. So I think that's something to consider. I mean, some might say, well, that's faster than they'd like. I don't know. But we did retain the optionality on this.
Jim Bullard, thank you so much for joining us this morning. It would be great to get your sense of Bill Dudley's comments about the end value, the end terminal rate that we are expecting for policy, given how high inflation has gone. A lot of people think it's not going to get beyond 2%. He said 3 to 4%. Do you think that that is a realistic end policy rate?
Yeah, that's not my base case right now. I've got rates only rising to where they were pre-pandemic, And I think it's good to keep in mind here that the pre-pandemic economy was not a zero interest rate economy. So whenever you think we're back to the pre-pandemic levels of output, which we already are, and the pre-pandemic level of labor market performance, then that should be the moment that you're back at the pre-pandemic level of interest rates. We don't really have that kind of plan in place right now, but maybe that's something to think about. I think, this rate policy and tacking hawkishly now could pay great dividends for the committee in the year ahead or the 18 months ahead, because it means that we would have to do less later on, and you'd smooth this whole process out some. I think the scenario that Bill Dudley was describing was one where we get behind the data too far, and then we have to move more aggressively later. And that was a stop-go type policy that didn't work very well in the 1970s. So I think it makes sense to try to move a little bit more hawkishly here and try to manage the inflation risk. Again, if it all dissipates next year, we'll be fine in that situation. Then we can push out rate increases out into the future.
But how high can rates go given where the economy is, and how quickly, right? I mean, the idea of front-loading rate hikes makes sense to avoid a sort of gloom and doom scenario that Bill Dudley was laying out, 4% rates, perhaps sending the economy into recession. But how high could we currently handle given the trillions of dollars of debt that we've incurred?
Well, I mean, I think the good news is you probably don't have to go to that high of a level to get a normal sense of interest rates. I mean, in 2018, 2019, 1.5% to 2% was kind of a common level, and that seemed to work pretty well for that pre-pandemic economy. There were some adjustments, some trade issues going on then, and other things, but I kind of take it as good news that we wouldn't have to go to that high of a level to remove the accommodation and remove the upward pressure that we're putting on inflation with our current policy.
Jim Bullard, Tom Keene, good morning to you, sir. Christopher Waller, who got an upgrade from your shop a few years ago, now governor of the Fed in Washington. You and Chris Waller did a retrospective off your regime paper of 2000, I believe it was 16. I can't quite remember. I want you to discuss now for the economic community if we're in a regime change where the theories aren't working. Here we are coming out of a natural disaster. We have a China-like boom economy of real and nominal GDP. And then we've got the idea that we have to somehow unwind this to the terminal value. Scope out, given a regime change, the when of a terminal value you're looking out to. Are you looking out 6 months? Are you looking out to a Cardinals World Series? Or can you responsibly look out 5 or 6 years?
I think this might be a moment where there is potential for regime switching to a higher productivity growth regime. I'm not really ready to commit to that right now. But if you look at the data, it's become very volatile. It's not so clear that we're in the low productivity growth world that I was talking about in 2016. We might push out of this. The pandemic is the kind of event that really forces businesses to hustle and to think about how they can use technology to their advantage. They've got a very tight labor market that they're facing. They're probably dusting off plans that they had around for a long time to use technology in a better way. So that's very promising. I think that we could move to a period of higher productivity growth. That would be great for the economy, and it would put upward pressure on interest rates as well.
So if we see that this is a critical theme for Bloomberg Surveillance this year, Jim Bullard, the idea of the technology overlay being underestimated as we come out of the war shock, the pandemic shock as well. If we get a technology overlay and an upgrade in our statistics, can we get to where instead of a 2% inflation target that we could migrate to something, as Adam Posen suggests, of a 3% inflation target simply because we have better productivity?
No, I think no, I don't think so. You should take the productivity on board. The economy would grow faster, and that would be a sensational thing. The last time we really had this was the late 1990s, and at that point we were talking about paying off the entire national debt. It didn't happen, but we were talking about it at one point.
Yeah.
And that just shows you what a big impact this kind of thing can have on macroeconomic performance. So I would not mess around with the inflation target itself. That's become an international standard. And if the leading economy in the world decided to mess around with the inflation target, you'd get all this chain reaction all around the world. I think that would be chaotic and sounds like the 1970s to me. So I would not try to go in that direction. But nevertheless, I think we may get the higher productivity growth that is kind of promising coming out of this pandemic, just because everyone has been experimenting with new technology.
Mike, did you see how he treated me there? Like you get treated by Chairman Powell in the press conference? I mean, he just laughed right in my face.
He laughed right in your face. Well, that was a long-term look at what might happen. Let's talk what the traders all want to know, Jim, and that's the very short term. If you're thinking we should tack in a more hawkish direction, would that speed up the rate of rate increases? There's right now in the markets 2 rate increases for 2022 and almost a third. Do you think that's realistic?
You know, I'm agreeing with the markets right now because I've got 2 hikes penciled in for 2022. That's dependent on the data. Could evolve going forward, depending on how the data come in. So I think there are other ways we could tack in a hawkish direction. I think we could play up the idea that maybe we don't have to wait all the way to the end of the taper in order to raise the policy rate. I mean, historically, when we've done this before, we have not wanted to be raising the policy rate while we're still tapering. But you could argue that the taper's all priced in, and what's going to happen over the next 8 months is just follow through on something that's already priced in. And so that would sort of relieve any constraint that the committee might feel about when the appropriate time was to commence with liftoff. Another consideration I think that I put on the table and have put on the table is that we could allow runoff of the balance sheet at the end of the taper instead of waiting on that decision for a while. So I think that would be a way to have a somewhat more hawkish policy than otherwise. We can debate how big an impact that would have, but you could allow the balance sheet to be running down sooner than is currently priced into the market.
One last question is, and we'll keep it in the sailing category. When you tack, you run the risk of the wind coming on too hard and you move the sail too much and you can capsize. And I'm wondering what your view of the U.S. economy is right now. Since policy works with a lag, do you risk cutting off the recovery by raising rates too soon if inflation is transitory?
Yeah, well, I love this. I mean, if you're going to be in sailing, you've got to be good at what you do. And I think the same is true of the committee. We have to react to data in the appropriate way and manage the risks appropriately. I liked the chair's emphasis on risk management at the recent press conference. I think that's exactly what's going on here. You have 2 scenarios, one where inflation dissipates as the economy continues to reopen, and another one where it doesn't, and you got to be ready for the second one. If the first one comes, we're in great position for that already. So it's really the second one that we have to get ready for here. And I hope we've got the gusts of wind. We're playing that just right here.